Warren Buffett's 10-year rule has become a cornerstone of long-term investing. The principle is simple. Before buying a stock, ask yourself if you'd be comfortable holding it for a decade, regardless of market fluctuations. This philosophy encourages patience, discipline, and a focus on enduring business quality. Over the years, countless investors have adopted this approach, believing it to be a path to steady growth and financial security. But, as its popularity has grown, a critical question emerges. Could this widely respected advice actually conceal hidden risks? Is it possible that following the 10-year rule might lead investors into unexpected pitfalls? The 10-year rule is frequently cited as a justification for maintaining investments that are underperforming. Investors may believe that simply holding on to an asset for a decade will eventually yield positive returns, regardless of its current trajectory. This mindset can serve as intellectual cover, masking the reality that some investments may never recover or achieve meaningful growth. By relying on the 10-year rule, individuals risk ignoring critical signs that an asset is fundamentally flawed or mismatched with their financial goals. Over time, this approach can lead to substantial financial losses as capital remains tied up in poor-performing investments. It's important to regularly reassess investment decisions and avoid using arbitrary timeframes as a substitute for sound analysis. Patience is often celebrated as a virtue, especially in the context of investing and personal growth. However, when a quote about patience is misinterpreted, it can inadvertently serve as a justification for inaction. Instead of encouraging thoughtful waiting, it may become a permission slip for complacency, allowing individuals to ignore warning signs or avoid necessary decisions. This mindset can lead to missed opportunities and, in some cases, catastrophic losses. By conflating patience with passivity, the original intent of the advice is lost. The challenge lies in distinguishing between strategic patience and unproductive stagnation, ensuring that waiting is purposeful rather than detrimental. The 10-year rule is often cited as a benchmark for achieving mastery, suggesting that a decade of dedicated practice leads to expertise. However, beneath its surface lies a psychological trap that can subtly shape our expectations and motivations. Many people accept the rule at face value, overlooking the complex factors that influence individual progress. To truly grasp its impact, it's essential to examine the hidden context that surrounds this idea. Without understanding the nuances and limitations, we risk falling into patterns of self-doubt or misplaced confidence. Recognizing these underlying dynamics is the first step toward a more realistic and empowering perspective on personal growth. Before we can understand the real purpose behind this rule, it's important to examine how it's commonly misunderstood. Many investors adopt a simplified version of the rule, believing it offers a straightforward path to success. This widespread misinterpretation often overlooks critical nuances and can lead to risky decisions. By dissecting this popular view, we reveal why it can be dangerous and why so many fall into its trap. Only by recognizing these misconceptions can we move closer to grasping the rule's true intent. Take a moment to consider your own investing experiences. Have you ever found yourself holding on to a losing stock, reassuring yourself that it's all part of being a long-term investor? If so, you're not alone. Many people use this reasoning to justify their decisions, even when the evidence suggests it might be time to reevaluate. We'd love to hear your thoughts and stories. Share in the comments if you've ever faced this situation and how you approached it. A widely held belief suggests that patience by itself is the key to investment success. This myth implies that simply holding on to investments without active evaluation will inevitably lead to positive outcomes. However, relying solely on patience can encourage a passive approach, where investors neglect to assess changing market conditions or the performance of their assets. Such uncritical holding may expose individuals to unnecessary risks or missed opportunities. While patience is certainly valuable, it should be complemented by regular analysis and informed decision-making. Successful investing requires a balance between long-term commitment and active engagement with one's portfolio. The myth is particularly alluring because it appeals to our desire for simplicity and reassurance. By suggesting that inaction is a form of discipline, it flatters investors into believing that patience alone is a virtue, regardless of the underlying quality of their decisions. This perspective can be comforting, as it shifts responsibility away from active management and onto the passage of time. Investors may feel validated in holding on to poor choices, convinced that time will inevitably transform them into successes. In reality, this mindset can mask underlying problems and delay necessary adjustments. The seductive nature of the myth lies in its promise of effortless improvement, which can be difficult to resist, especially in uncertain markets. It's a common misconception that simply holding on to investments for a long period will inevitably lead to success. While time can enhance the value of truly excellent businesses, it can just as easily magnify the problems of poor ones. If a company lacks a solid foundation or faces persistent challenges, holding its stock for a decade may result in significant losses rather than gains. Longevity alone does not guarantee improvement. In fact, it can deepen existing issues. Prudent investing requires careful selection, not just patience. Choosing quality businesses is essential, as time rewards excellence but punishes mediocrity. While timing often dominates investment discussions, it's crucial not to overlook the fundamental quality of the business itself. Relying solely on when to buy or sell can distract from evaluating the company's long-term prospects, competitive advantages, and financial health. True investment success is built on understanding what makes a business resilient and sustainable, rather than just reacting to market cycles. By shifting focus to the underlying strengths and weaknesses of a company, investors can make more informed decisions that stand the test of time. This perspective helps avoid the pitfalls of short-term thinking and highlights the importance of thorough research and analysis. Buffett's 10-year rule serves as a pre-purchase filter, guiding investors to carefully consider their commitment before buying a stock. Rather than acting as a strict command to hold an investment for a decade after purchase, the rule encourages thoughtful selection and long-term thinking. Its purpose is to help distinguish true investors who focus on enduring value from speculators who chase short-term gains. By asking whether you would be comfortable owning a stock for 10 years, the rule prompts a deeper evaluation of a company's fundamentals and future prospects. This approach fosters patience and discipline, qualities that are essential for successful investing. The true purpose of this rule is to serve as a mental model, helping you evaluate your understanding and confidence in a business's ability to endure over time. Before making any investment decision, it encourages you to pause and consider whether you genuinely believe in the company's long-term prospects. This approach goes beyond short-term trends or market hype, focusing instead on fundamental qualities that contribute to lasting success. By applying this mental model, you can better assess whether a business is built to withstand challenges and adapt to change. Ultimately, it's a tool for fostering thoughtful, conviction-driven decisions rather than impulsive actions. The 10-minute speculator is primarily focused on rapid price fluctuations, seeking quick profits from short-term market movements. This approach often relies on trends, rumors, or technical signals, with little regard for the underlying health of a company. In contrast, the 10-year investor takes a long-term perspective, carefully analyzing business fundamentals such as revenue growth, management quality, and competitive advantages. By prioritizing these core elements, the long-term investor aims to build sustainable wealth and weather market volatility. While short-term speculation can be tempting, it often leads to unpredictable outcomes. Understanding and evaluating the true value of a business provides a more reliable foundation for investment decisions. Many investors believe that simply waiting and being patient will lead to success in the market. However, this myth often overlooks the importance of active analysis and informed decision-making. The gap between passive patience and proactive evaluation is where mistakes are most likely to occur. Without careful research and ongoing assessment, investors may miss crucial signals or opportunities. This disconnect can result in poor timing, missed gains, or unexpected losses. Recognizing the need for both patience and active engagement is essential for navigating the complexities of investing. While the quote may offer comfort during periods of uncertainty, it can also become a trap for investors. By clinging to the idea that markets will eventually recover, individuals may ignore warning signs and hold on to poor investments far longer than they should. This mindset discourages critical reassessment and can lead to mounting losses. Instead of objectively evaluating whether their original decision still makes sense, investors may use the quote as a justification for inaction. Over time, this approach can erode both confidence and capital, highlighting the importance of regularly reviewing and adapting investment strategies. When investors experience a financial setback, it's common for them to seek comfort by recalling familiar sayings or quotes. One such quote, often intended to promote patience, is retroactively applied to justify holding onto a losing position. This psychological process helps soothe their ego, making the loss feel less like a mistake and more like a test of endurance. However, in doing so, investors may blur the line between patience and stubbornness. Instead of objectively reassessing their decisions, they cling to hope, mistaking inaction for wisdom. This tendency can prevent them from making necessary changes, ultimately prolonging their financial difficulties. It is important to recognize the risks of using inspiring quotes as a way to justify poor choices or avoid responsibility. When we rely on such phrases to soothe the discomfort of our mistakes, we may fall into the trap of intellectual laziness, choosing comfort over critical reflection. This habit can foster denial, preventing us from learning and growing from our experiences. Weaponizing quotes in this manner undermines their true value and can perpetuate harmful patterns. Instead, thoughtful engagement with wisdom encourages accountability and genuine progress. The essence of the 10-year rule is not simply about following a timeline, but about cultivating a mindset that prioritizes long-term safety and peace of mind. By approaching decisions with a decade-long perspective, individuals can better anticipate potential risks and challenges. This mindset encourages thorough analysis, ensuring that choices made today will continue to provide ease and security well into the future. Ultimately, the true value of the 10-year rule lies in its ability to guide us toward thoughtful, well-considered actions that stand the test of time. True safety is not simply a matter of waiting for time to pass. Instead, it arises from careful analysis and informed decision-making. Peace of mind is achieved through understanding the facts and risks involved, rather than ignoring them. When we take the time to research and investigate thoroughly, we lay the groundwork for genuine confidence. Ease and assurance are the natural results of diligent preparation and thoughtful evaluation. In this way, knowledge and effort become the foundation for lasting security. Consider using the 10-year rule as a guiding principle for your future decisions, rather than a way to rationalize past choices. When evaluating a business opportunity, ask yourself if you genuinely believe it's worth holding on to for the next decade. This approach encourages a long-term perspective and helps you focus on sustainable value. By applying this filter, you can avoid impulsive decisions and prioritize investments that align with your enduring goals. Remember, the goal is to look forward and make choices that stand the test of time. If you found this content valuable, don't forget to like and subscribe to stay updated with our latest insights. We invite you to share in the comments your most conviction-driven long-term holding, and the reasons behind your choice. Your experiences and perspectives can inspire others in their investing journeys. Additionally, if there's an investing quote you'd like us to analyze in a future episode, let us know below. Your suggestions help shape the direction of our discussions and ensure we cover topics that matter most to you. Thank you for joining us in exploring the importance of critical thinking when making financial decisions. By staying informed and cautious, you can better navigate the complexities of investing. Remember, true long-term wealth is built through patience, careful planning, and a commitment to sound strategies. Avoid shortcuts and promises of quick gains, and instead, focus on investments that align with your goals and values. Your financial future is shaped by the choices you make today, so invest wisely and thoughtfully.